For more on both companies' quarters, we're joined by Stewart Glickman, an energy analyst with CFRA. Thanks so much for joining us today.
Sure. Thanks for having me.
So just looking at the reaction in Chevron's shares today, down quite a bit. And I wonder, maybe we can start there with Chevron and, the disappointment, I guess you could read into from that reaction. Do you think it's warranted today?
Yeah, I'm not surprised that the shares sold off today. 6% is a little bit of a big reaction, I guess. But I think there's a little bit of sticker shock. They had earnings of $3.05 on an adjusted basis. That's about 16% below what expectations were. Certainly Exxon missed, but not nearly as badly. And I think that part of it is from cost overruns in the international sphere, delays in getting projects going. So I think all of those kind of conspired to put downward pressure on the outlook. Because some of the growth projects that Chevron is counting on for 2024, 2025, a little bit delayed and probably not going to throw off as much free cash flow as previously thought.
Yeah, it sounds like there was quite a focus on that delay when it comes to the project in Kazakhstan on the conference call with analysts. And the CEO said, we're close to the finish line on this thing. What would be the fallout, though, if there were more delays when it comes to this particular project?
Well, certainly, with international projects, there's always a little bit of enhanced risk. And should that occur, if we were to get more delays, then that is going to put downward pressure on expectations for production, downward pressure on cash flows, and so that would end up getting reflected in valuation. But to be fair to Chevron, they're not new at this, right? Going back about 3-4 years, a little bit before the pandemic, they were able to successfully pull off commissioning of 2 very, very large liquefied natural gas projects in Australia, and really pulled that off quite well at the same time that they were kind of working on some cost efficiency efforts. So I do think it's a well-run company. I'm a little surprised at the delays. And I think they're going to bounce back from this. And
Chevron has this Hess acquisition that's underway as well. The price tag, the $53 billion. What do you think of that? Is that, good? Would it be getting good value for that money, do you think?
Right. So if you do the math, it works out to a little over 8 times forward EBITDA, 2024 EBITDA. That's where Hess has normally traded in the last 5 years. So effectively, Chevron's getting them for a low single-digit premium, which is kind of unheard of. When you typically do major acquisitions, normally you have to pay up for them. This is really not much of a premium. Now, to be fair, you're paying 8 times EBITDA. Chevron as a whole trades lower than that, so you're paying up a little bit richly relative to how you trade yourself. But I think for what they're getting and the growth prospects that are going to come off of the production that's coming out of offshore Guyana, I think is worth it for them. And this really enhances their production capacity down the road.
Now, you kept your buy rating on Chevron, but cut the price target by $18, Stewart?
Yeah, so our prior price target was 180. We cut it 10% down to 162. What this reflects really is slightly reduced expectations near term, I think, to reflect slightly higher risk. The fact of the matter is that they are going to have to execute on this Tengiz expansion project. And so from a calculated risk standpoint, not quite as strong a multiple as we previously applied. 5.5 times forward EBITDA is a slight discount to where Chevron normally trades.
If we shift to Exxon, it also has a deal on the horizon as well, this $60 billion deal to acquire Pioneer Natural Resources. And you highlighted that the company provided some more details on that. What should investors take away from those details?
So Exxon's purchase of Pioneer is a very different one than what Chevron is getting with Hess. So Hess is really kind of long cycle production offshore Guyana. Pioneer is getting you short cycle production in the Permian Basin, where Exxon already has a major presence. And so what you're doing is you're kind of combining Pioneer's very large acreage position with Exxon's technology. And so what this should be able to do for Exxon, on the one hand, you should be able to get some revenue synergies where you have adjacent acreage. You can probably run longer laterals and squeeze more juice out of the orange that way. And then secondly, by applying higher end technology that Exxon already has, you can probably reduce your cost base. So there was a little bit more flesh on the bones today with respect to what those synergies might look like. And we upgraded our opinion on Exxon to a buy from the hold. So the fact that the stock is trading off today about 2% makes, in our opinion, a decent entry point.
You upgraded it from a hold to a buy.
Correct.
You did. Okay. And that's a reflection of understanding more of what's happening with that deal and the value of it.
So a reflection of that, also a reflection of the fact that we think that oil prices, spot prices globally are probably moving up in 2024. Your prior segments with the Exxon executive mentioning that there's been undersupply since the pandemic, I think that's really understating it, to be honest. This industry has largely underinvested in new supply going back probably to late 2014. So you had 6 years of underproduction, then the pandemic hit, and then everyone was kind of in survival mode. And now we're kind of exiting the pandemic, and people are I think, legitimately questioning, are we going to have enough supply to keep pace with natural demand? And I think that's putting upward pressure on prices.
Yeah,